Hey y'all, I wanted to do a quick video about what's going on in the economy and how it affects your money, right? So we've got inflation is through the roof. We've got interest rates have gone up. The stock market is down and has been for a little while. Things are just happening in the economy and you hear it on the news and you're like, oh my goodness, what are we going to do? So I want to do a quick video about that. For those of you that don't know me, my name is Chane Carter. I am the founder of Empower Financial Planning. I am a financial educator. And I just want to talk a little bit about what's going on in the economy and how it affects you. So let's talk about these interest rates. The Fed, and you'll hear them say the Fed sometimes, that is the Federal Reserve Bank that sets interest rates in the United States, basically sets a baseline for what banks charge for interest. And then banks accordingly increase or decrease based on what the Fed does. So this week, the Fed increased the interest rates, which means it makes it more expensive to borrow and you get better interest when you're saving. You put your money in the bank, you're going to put it in a savings account or a money market account or some interest bearing, meaning earning interest bearing account, and it's going to earn interest. So when interest rates go up, that means your interest bearing accounts make more money. That is a good thing. So if you have money in the bank and interest rates go up, then you're doing good. You're doing well. That is a good thing for your money. If you are borrowing money from a bank, you're not saving, but you're actually borrowing money. You're getting a loan for a car or for a house or for some other purpose. If you're borrowing money and interest rates go up, then it costs more to borrow. You're paying more to borrow that money. And obviously that's not a great thing, right? So they increased the rates. And I've heard that people are kind of bugging out about that. Well, it only affects you, really, if you're borrowing money. And let's talk about what you might be borrowing for. Your house. There are two types of mortgage. There are lots of mortgages, but there are two that I want to talk about: fixed and variable. If you have a fixed rate mortgage, which means your mortgage rate is locked in for the length of your mortgage, then the increase in the mortgage rates or the interest rates doesn't affect you. If you have a fixed rate mortgage, that means your interest rate is fixed forever. You don't have to worry about the feds increasing or what's going on in the economy because your mortgage is fixed, or at least the interest on that mortgage is fixed. The other type is variable rates. These rates change. You probably got a very low interest rate when you signed your mortgage documents, but it changed based on the feds. Well, the feds just went up. So you might need to check with your lender to find out what that will do to your mortgage rate if you have a variable rate mortgage. Now, it probably won't change immediately, but in the next 6 months or so, there may be a change. If you have a variable rate mortgage, you might want to check on what that's going to do. So that's the interest rates. The flip side, of course, is what I mentioned before. If you are saving money, you have a savings account, a money market account, or some other account that's tied to interest rates, you might want to go check, see what you're going to get from that rate, from that account now. Because saving money when interest rates go up is a good thing. So that's interest rates. That's something that we're hearing about and makes you feel like, oh my goodness, I should do something about it. Likelihood is you shouldn't do anything about it. You should just go check on the things that you're borrowing or saving to know how they affect you. Next is the stock market, right? So we are hearing that the stock market is dropping. It is down in the dumps. Things are bad, right? It doesn't matter. It doesn't matter. I know it sounds terrible, but if you are investing in the stock market for the long term, then what happened today, what happened this week, that happened this month, doesn't matter to you because you are a long-term investor. So you're not watching the stock market go from day to day or week to week or month to month. You are looking over decade to decade. Now, if you're an investor that is investing short term, and there are some of you out there that are looking at short-term trading, you are doing day trading, or you're doing different types of investing, then what's going on a daily basis will affect you, and you should go check it out. I'm not that kind of investor, so I don't have those kind of issues. For those of us that are investing for the long term, it doesn't matter what happens on a daily basis. So that means that you need to make sure you are investing for the long term. If you have a shorter horizon for investment. For example, if you are retiring in the next 10 years, if you are retiring in the next 5 years, you need to go look at your investments because they should be in more conservative places. They shouldn't be in places that are affected on such a volatile day. So if you are being affected on a daily basis by what's happening, you shouldn't need that money in the next year or 2 or 3 years. That's not where that money should be. But for most of us who have more than 5 to 10 years of investments to go forth, we're not worried about the daily things that are happening or the weekly things that are happening with the stock market. Stop letting that bother you and let it go. We are in here for the long haul. And the last thing, inflation. So inflation is when the prices of things go up. They will not go back to what they were. We do not spend the same amount on bread that we did in 1950. We will not spend the same amount on bread that we did in 1990. And we will not spend the amount on bread that we spent last year. Prices have gone up. That is what inflation does, right? So there are basically two things you can do about inflation. You can either make more money so that those fluctuations in prices or the rise in prices doesn't affect you, or you can stop spending. Now, I know it's hard to stop spending, but you can adjust yourself such that you are not being affected by inflation by changing your spending or increasing your income. But those are the only two things that you can do about inflation. So if you're not going to do those two things, there's no need in complaining about it. There's nothing you can do. Prices are going up. Either make more money, however you make that, or change your spending. I just wanted to quickly say those things because people are bugging out. They are bugging out like a recession has never happened before. If a recession is going to happen, it has happened before. We have done this before. So don't bug out. Prepare yourself by doing the things you can do. Changing your income, changing your spending, checking on what you're saving, checking on what you owe, checking on what type of debt you have, whether it's fixed or variable. Those are things you can do, things that you can control. There are things you cannot control. Interest rates, inflation. Those are not things that you have anything to do. Even the stock market. These are not things you can have any control over. So I would say when you're listening to the news and you're hearing all this doomsday stuff, y'all don't worry about it, right? Do the things you can do, control the things you can control, and let the rest of it go. So I hope that helped. I hope you got some value from it. If so, I would love it if you would click like and subscribe. That would be awesome. And also join my Facebook community, Empower Financial Planning. I hope to see y'all in there. Y'all take care.